Hi, I'm James Robinson, and this is my stock pick of the week. This is part two in my 5-part series on the company Encore Wire. Part two deals with the company's operations. What I'm looking at here is what kind of job does the company do and how efficient a job does the company do in delivering goods and services to the customer. Encore Wire is an old line manufacturing company. They make wire, so they take copper, they press it into wire, which obviously is very old school manufacturing. It's not going to have the same economics as a software company is, for example. It's going to be much less attractive, but there's reasons why we're going to buy this company that we'll talk about as the video goes on. The other videos that I do on a company, I do an overview, which is just a look at the basics of the company and the fundamentals that have me interested in the company. I do this video on operations. I'll do one on the balance sheet, which looks at the company's debt and their assets. And the reason we look at that is to see if the company is safe and is able to survive an economic downturn, for example. Then I look at the company's dividends, not just how much the company pays in dividends and how quickly they're growing, but how safe and how likely the company is to be able to continue to pay dividends on an ongoing basis. The final video that I do is called Wealth Creation. What I'm looking at there is the job that the company does in providing goods and services to the customer. How good a job the company does, the management does in enriching the shareholders. So what is the company doing that's going to make us richer in terms of dividends, buying back stock, reinvesting the money, retaining earnings, those kinds of things. So I'll put down in the link below links to all of the other videos as I make those other videos. So you'll find those in the next few days. As a value investor, what we're looking for are companies that have a durable competitive advantage. That means that they have a pricing power over their competitors, and that means that the company will do better in downturns, but also that the company can charge higher margins and thus generate more profits for us. They also will generally do better in inflationary times. And so whether you call that a moat or whether you call it a consumer monopoly, what we're looking for is companies that have this special je ne sais quoi that lets us believe this company is going to be special. I believe that that can often be found by a company's gross margins. The gross margins is simply you take the total revenue and you subtract from that the cost of goods sold, and that leaves your gross profits. And the gross profits as a percentage of gross revenues is your gross margin. And the larger that is, that means that the company has an ability to price the product significantly above the cost to produce the product. And I think that situation only occurs when a company has an advantage. Now, whether that advantage is durable is something else that can be determined, and whether it's the result of some patent, for example, or it's the result of a consumer monopoly or some other factor. Perhaps it's a cyclical, and that product is really in the cyclical vogue right now, for example, which is happening with copper. The cost of copper is very much lower. Whatever the reason is, the first thing we want to do is find out if that exists. And the way we do that is by looking at margins. And then once we believe that maybe it does exist, then we start looking at how durable it is and whether the company becomes investable. So that's a pretty long preamble, but in looking at gross margins for this company, what you'll see is that this company, the red line represents the minimum gross margins that I would typically consider to be investable. And you can see that this company has been below that line really up until about 2 years ago. And so you say, why am I saying to buy this company? Well, it's not because I think it is a durable competitive advantage. I don't think it does. As a consumer monopoly, this company doesn't measure up. But what they are is in the right place of the cycle, because the price of copper is very low and the demand for copper seems to be high, at least in America. And the resulting is that we're getting really, really big margins right now, much more than we'd historically get. That in and itself would basically make you say, well, great, but you're taking a risk that things are going to turn around. And that's true. But the fact is that the price of this company, the PE of this company hasn't adjusted yet. We're still buying this company at 4 times earnings. And when you can buy it at 4 times earnings, I mean, if the earnings get cut by 75%, you're still at 12 times earnings, and it's still not bad. In addition to that, even though the gross margins have historically been low, they are high now. And the company's using all those massive profits, or a lot of those massive profits, to invest in the business a little bit, but a lot to buy back stock. And by buying back stock, that means that I'm buying the company now at very, very low PE. The company's taking all those profits, buying back stock, which means I'm going to own ever more of the company without investing any more money. And finally, the company has no debt, which I think is always something that makes me interested in a company when I know the competitors to the company do have a lot of debt. So it's a really, really long way of explaining why I look at gross margins and why I'm willing to overlook gross margins as it relates to Encore Wire. So here you can see the massive change in earnings. This company went from earning, let's call it $75 million a year, to $550 million a year. And it looks like that was in 2021. And it looks like in 2022, they're going to make over $600 million. So these are very, very outsized returns. This company's just piling money up, and they're using that money to buy back shares. They haven't paid back debt. They don't need they spent $100 million on capital expenditures. And so they don't have a lot of need for cash, and they're going to return it to us, the shareholders, in one way or the other. And so I'm simply riding this big boom. The price of the company hasn't adjusted yet. So, and again, as I say, it's 4 times earnings. So basically the market is saying, well, these earnings don't make sense and they're temporary and this thing's going to drop back down. And that's true. But by the time it does, the company will have bought back about 20% of its shares, I think. And that means that I'm going to own 20% more of the company than I paid for. And I like that. So that's why I'm looking at this company. Both the earnings and the earnings per share have gone up dramatically. And I expect that in 2022, that will continue. I don't have a crystal ball into 2023 or 2024, but at least for the time being, I think we're in good shape. And, it wouldn't be the end of the world to buy this company and put a stop loss on so that you can make sure that you didn't, that you do well if things should change too rapidly. This slide is looking at net earnings as a percentage of revenue. So what percentage of the company's sales become profits? And you can see that the bottom 25% of companies are, in the range of, slightly above zero. The margins for the top 25% of companies are around 10%. And this company's sort of been in the middle of that number. That's exactly what you would expect. This company has, it's an old line manufacturer. It's got a giant 2.8 million square foot warehouse. It's got a ton of machines in there. They bring in raw copper, out comes wire at the other end. This company isn't making software where they have these competitive advantages in terms of the product costing nothing to produce. So I'm not surprised by these numbers. You can see that again for the last year, they're approaching the top 10% of companies in terms of profitability. Again, I think this is a relatively short run thing, a few years, a few quarters, but I think it'll continue for at least the next 2 or 3 quarters. And I think that's going to be long enough for us. The next thing you look at is net revenues. You see the revenues have exploded, which has caused the earnings to explode. The neat thing here is revenues have exploded and margins have exploded. And that's a good double whammy for us. That's how you've gone from 75 million in earnings to $500 million of earnings in a year in the same industry. And really, again, an old school industry it's like there's been some massive technical change, which has given us a technological advantage. They're just doing what they've always done. They're just doing it on much better market conditions. So once a company has created their sales and they've paid off the cost of goods sold to manufacture the product, there's still a bunch of operational things that have to happen from that product to go from the warehouse to the customer. One of those things is sales. Another thing is general administrative costs, which is, rent and actually not rent, but it's, employees and administrative costs. And so I like to keep an eye on those. And that's one of what I call the 4 taxes. There are these 4 categories that most companies have to expend money on to some degree. The 4 taxes I see them are sales and general administrative, there's plants and equipment, there's research and development, and there's inventory. And all of them some companies have a very high cost in some and a very low cost in others, but I like to keep an eye on all of them and have a sense of what they are. So selling and general administrative, these costs have been very, very, and by the way, it's selling and general administrative as a percentage of profit. And they've always been, again, sort of in the middle of the pack for this, which is, again, what you would expect. There's nothing special about making copper, no reason for them to have a competitive advantage. In the last year, that number has exploded and gone very, very high. I think that's as a result, just the fact that their prices have gone up and the products, they're making so much money. There's probably some inefficiencies there because they're making so much money. I'm not that worried about it, but it's higher than I'd like it to be. And so we'll keep an eye on that. The next one is plants and equipment. You see plants and equipment for this company, they're in the bottom 5%. I don't like that. One of the reasons why I don't like plants and equipment being so high is because equipment wears out and plants wear out. And if you've got a tremendous need for plants and equipment, that's typically an ongoing need. You typically are constantly reinvesting in that stuff. And that means that that's money that, because you have to reinvest in plants and equipment, you can't give that money back to the shareholders. And so I try and avoid companies that have this really high plants and equipment. And this is another reason why this is a company that I'm not telling you to buy because of operations. I'm telling you to buy it because of sort of these special circumstances. So inventory as a percentage of revenue, there are several reasons why I don't like to see big inventory numbers. The first reason I don't like to see big inventory numbers is sometimes inventory goes stale. Obviously, if your inventory is made up of bananas, you have a few days to sell those before the bananas goes bad and your inventory is worthless. If your inventory is iPhones, you have a few months to get rid of the product, but a year and a half from now, an iPhone 10 isn't worth what it was when it was first made, 3 or 4 years ago. So oftentimes inventory will go stale over time. The other thing is that you're tying up a bunch of money in inventory, and that's, again, money that has to be kept for the purposes of inventory and can't be given back to the shareholders. And so I don't like to see a lot of inventory when I'm looking at a company. The interesting thing here is that since 2014, the inventory has gone down every year. This is inventory as a percentage of revenues. So even though the revenues have been going up, the inventory requirements have been going down. That tells you that either this company is getting very efficient at just-in-time delivery, or that there is ever-increasing demand for this company's product and they're having trouble keeping up with the demand. Either way, it's a good sign. I like to see those numbers going down. And again, we saw the high plants and equipment, and we saw the generally high cost for selling a general administrative. Well, this sort of offsets that because this number is very low. Obviously, R&D for this company is, as you can tell from this chart, is at zero. That's very, very good. I always wonder why companies don't spend some money in R&D just to try and improve and beat their competition in any way they can. But most companies don't seem to want to do it. And so I recognize that. And so while plants and equipment and some general administrative were high, inventory is pretty low, and R&D is zero. So those sort of wash out and make me feel more comfortable about the 4 taxes for this company. The next tax, which is the 5th tax, and I call it the self-inflicted tax, is interest expense. Companies that have to pay the bank or pay the bondholders typically have to pay them first. And it's also, unlike the other 4 taxes, not something you can adjust very easily, or at least very cost effectively. Your interest payments have to be paid. The bank wants their money. If they don't get their money, they can take your business away. So you have to pay them. The only way to get rid of that is to spend a giant amount of money to pay off the debt. But when a company has no debt, they have no interest payment, and that's a really good sign. It means that their costs are lower. It often typically means that their costs are lower than their competition, and it gives them a pricing advantage when things get tough. So again, seeing no interest payments is a really good sign for me. And it's one of the things that really has drawn me to this company, because I believe that when the price of copper adjusts, we'll notice that this company is still able to make a significant number of sales because there's a pricing advantage due to no debt. Another thing that's very interesting is I gave you guys a tip a couple weeks ago to buy the company BHP, which is one of the largest copper producers in the world. And that sort of creates a hedge for me. If the price of copper should go up, my BHP stock will go up dramatically. If the price of copper stays low, then this company, Encore Wire, will do spectacular. And one or the other seems to me like it will happen. I suppose if they met in the middle, then both of them would do pretty good, and I could live with that as well. So that's sort of, I didn't really do this with an intended hedge, but it's one of those happy circumstances or happy coincidences. So I'll give you the summary of operations. I look for companies with growth margins of at least 40%. The minimum gross margin I'm typically interested in is 20%. For the last couple of years only, this company's gross margins have been above my goal, or at least above my minimum, but that's temporary. I know it's temporary. I think it's going to last a couple of years, and I think we're going to get out okay, because we're going to have this company buy back a lot of stock. And theoretically, the company's PE ratio might go from 4 to 6, which isn't a very big increase, but which is a 50% increase in the stock price of the company. The earnings have exploded over the last years due to both high demand and low copper prices. And as long as those conditions remain, the company will do spectacular. I've already mentioned that in addition to that, I have a bit of a hedge against it if it goes against me. The company is only currently attractive for a number of reasons. It's not attractive as an operating entity. I probably wouldn't buy this company if it didn't have these other sort of spectacular attributes. But the company has a very low PE ratio. I'm buying it at 4 times earnings. It's got a very high amount of stock repurchased over the last 12 or 18 months. The company, and we'll talk more about that in the wealth creation phase video. The company has about $500 million in cash. They have about $500 million in real estate, which they own no debt on. So that's $1 billion on a $2.5 billion company that's just hard assets. And the company has no debt, and so it'll have a competitive advantage against other copper manufacturers likely if and when the market should change. So as a result of those things, more than the operations, I think you should consider buying this company. Again, we talked about the selling general administrative is much higher than I would like or expect to see. Again, I think part of that's the fact that the product has no moats. One piece of copper wire is like any other, so they have to work real hard to sell it. Plants and equipment are much higher than I think. Again, I told you why I don't like that, but it's sort of par for the course for a company that is an old line manufacturer. The good news is there's no R&D and also no interest expense and very, very little inventory cost. And the other thing I didn't mention in the inventory slide is that the inventory never goes bad, right? I mean, they use the need for copper wire, the exact same copper wire they produce today. It's going to be the same copper wire in 10 years and it's not going to go bad. It doesn't rust, for example. So the inventory's shelf life is very, very long. Again, the company has no interest expense. And just as an aside, with the economics of this company being where they are in its size, I wouldn't be surprised to see this company be taken over by somebody. And obviously that was to happen, that would probably accrue to our benefit as shareholders. So that's the summation and the story for the operations of Encore Wire. Again, I'll put the links down below for the other 4 videos under Encore Wire.